Let's switch gears and move away from debt investments and look a little bit more at equity investments in these videos. Equity investments, like debt investments, can be carried one of three ways. But unlike debt investments, it really isn't about the management's intent. It's about the influence we have on the company we're buying stock in. So most investments lacks significant influence. It's a normal investment. We're just buying stocks for the investment piece, not to influence their decisions. So typically in accounting, if we hold less than 20% of the shares of the company, we account for it using what we call the fair value through net income approach. Basically, it's the same as the trading security for the debt piece. We mark the position to fair value before we produce financials, and we recognize any unrealized holding gains or losses as a result of the change in fair value. So that's one possible way. The second way is if we have some significant influence. In other words, if we hold about 20% up to about 50% of the shares of the company, we are considered to have an influence on that company, and typically we do that to have some type of relationship with that company. In that case, we typically use what we call the equity method to account for the position. Now, even in that position, we can elect a fair value accounting approach, which we'll talk about a little bit later in the videos. But if we hold 20 to 50, we usually use, or we can use what we call the equity method, unless we elect the fair value option. Now, last is if we own more than 50%. Now, we have a controlling interest in the company once we hold more than 50%. In that case, we actually have to consolidate our financials. Now, we will not cover consolidations in this chapter or in this class, so don't worry about that. But keep in mind there are three ways. We either account through it through fair value, or we do the equity method, or if we own more than 50%, we actually have to consolidate. So 0 to less than 20%, well, let's rephrase. Less than 20%, we use the fair value through net income approach. 20 to 50%, we use the equity method, or we can elect the fair value option. Greater than 50%, we actually have a controlling interest, therefore we consolidate. So that's the three ways we can account for. So to further this, let's look at an example. Now here we're only buying 5%. So we're going to use the fair value option, or the fair value through net income approach, as it is known, which acts like a trading security actually. So on January 2nd of year 1, Jordan Tobacco bought 5% of Benson Industries capital stock for $30 million. Benson Industries net income for the year ended December 31st, year 1, was $40 million. The fair value of the shares held by Jordan was $32 million at December 31st. During the year, Benson declared a dividend of $20 million. All right, so what entries would we record? Well, let's start with the purchase January 2nd. On January 2nd, we're investing in this stock, so we're going to hit an investment account. That is going to be an asset. So investment in Benson stock, and we're going to hit that for the $30 million. Again, we're going to do this in millions, so I'm just going to say 30 and so forth going on, but keep in mind these numbers are in millions. All right, and then we record how we purchased it. And again, that's for this or the equity method. We have to put the investment on our books at the purchase price of the investment, okay, the amount we paid. Now, that stock is going to sit there. Now, we really aren't interested in the net income of the company as far as journaling goes. So that sentence is just added information. It's great that they made $40 million. That may make us or help us decide if we're going to keep the investment or eventually sell it. But that has no bearing on the entries from this standpoint. What does have a bearing is the next two statements. One, the fair value of Jordan is $32 million. And during the year, they declared and paid $20 million in dividends. Let's start with that dividend. Now, it doesn't say exactly when they paid it, so let's just do it as of December 31st to record the dividend. When the company declares and pays dividends, we're actually going to receive our portion of that. So we're going to debit cash for the amount we receive. Now, remember, this is a total of $20 million. We do not own all the shares in this company, so we're going to take that $20 million and simply multiply it by the percentage shares we own, and we own 5% of those shares. So when we do that, we actually come up with, so 20 million times 5% equals 1, or 1 million. So that's the amount we're actually going to record. So 20 million times the 5% we own gives us 1. So we're going to record our 1 in dividend. Now what is that? Well, it's dividend revenue. So we're going to go in and hit dividend revenue on the position. Again, revenues are typically credit accounts to recognize revenue. So we do have to take into account the actual recognition of the dividend payment that we received. All right. Now, what else happened? Well, when we're accounting for equity securities less than 20% ownership, we must record them at fair value. So on December 31st, if our market value has changed, before we can produce financials, we must record that. Now keep in mind, some companies may record fair value on a daily basis or every month. We have to record it before we produce financials because we have to carry it on our balance sheet, our financial statements, at fair value. So that's the reason we just simply skipped on to December 31st. Keep in mind, you may do this every single day if you're actually in the industry recording these to monitor the fair value and know what you're making or losing on that position on a daily basis. All right. So on December 31st, we do have to mark this to fair value. And this entry is going to be similar to what we did with the debt securities. First, we need to compare what we paid or what we're carrying it at. So notice we're carrying it at 30. That's what we put it on our books at. And we haven't made any adjustments, so we're still carrying the stock at 30 million on our books. So let's check fair value. Currently, the stock is worth 32 million. Is it the same? No. We actually then have to record an entry. Now, did we gain or did we lose in value? Well, it went from 30 to 32, so we gained 2 million in value. So we need to increase, and we're going to use that same fair value adjustment account. We need to increase the value of the asset on our book. So to do that, we have to debit the fair value account for the 2. Now, if the value went up, that means we're recognizing, well, we're not recognizing, but we need to record some type of gain. Well, it's not a realized gain because we haven't sold the position, so we need to hit what we call an unrealized holding gain. And again, for equities, it's like the trading security, so that's going to be reported on our income statement. So we're going to hit it to an account that will definitely go to our income statement. Even though it's unrealized, we still report it as income. Of course, we would disclose that it is unrealized, that we're holding that position, that that's the change in fair value in the notes of our balance sheet or our financial statements, but we do have to report that in the income of the company. So that would be it for year 1 in this investment. We purchased it, we recorded any dividend. Notice stocks do not bear interest, so we would have no interest revenue on a stock position, just dividends if the company elected to pay them. And then we do have to mark that at some point to fair value before we can produce financials. All right, so let's go on and look at year 2 for this position. Assume that we sold the stock on January 2nd of year 2 for 36 million. So what do we need to do? Well, much like the deposition, the first thing we need to do is make sure that we update our fair value. And there's a couple of ways to actually show this, and we'll talk about others in class. But to follow the textbook, this is what they're going to do. They're going to update the fair value. So we need to, you know what, I just started typing without thinking. We need to decide, do we need to increase our fair value or decrease it? Well, looking back at last year, we put it on at 30 and we increased it by 2. So as of January 1, we're carrying this position at 32 million. Okay, we've already got it there. What's the value as of the date of sale? Well, it's up to 36 million. So how are we going to get from 32 to 36? Well, we need to add 4 million increase in value. So again, this is going to be a gain, so we're going to put in that we're increasing it by 4. And then since this continues to be a gain, we're going to hit the unrealized holding gain. Now again, on our income statement, since we're selling the position, this will be a realized gain and we'll report it as such. But to record it on our books, we're going to put that gain on there in our income statement. We know it's realized, but we just need to adjust to fair value. Then, once we've got that adjusted and we're showing it at 36 million and we've recorded the income, notice we bought it at 30. We're going to recognize a total of 6 million in income, or not income, in gain on this position. However, we need to split it by the years in which we had the gain. In year 1, we showed 2 million in gain. In year 2, we had 4. So a total of 6 in total gain on this position. So when we go to sell it, we're going to record the cash, and we're going to record the cash at the amount we sold it for, the 36 million, the fair value. Now, just like the bond, we need to remove the investment from our books. So we're going to hit the investment in Benson stock. You could just do investment stock there, but I like to track whose stock it is. And we're going to take it off at the original 30 that we put it on at. So just like before, if you look, you recorded at 30, so we need to take it off at that 30. Now, where's the difference? Well, that's 6 million. What's representing that? Well, it is the gain overall, but we didn't recognize all the gain this year. We need to take it out of the fair value account. So we're going to hit fair value adjustment for that 6 to balance out. So we've recognized the 6 in income already, so we just need to get rid of the full amount of the balance sheet at 36. So that's how we would actually record the sale of the equity position.